I'll answer it more broadly, and then I'll answer it as it relates to Lyndhurst. So I think there's no one size fits all. Managers come from different backgrounds. Managers come from different pedigrees. There are situations where a manager's worked for a Tiger Cub, or they've worked for Michael Price, where they've been there long enough, they've had client-facing time, and there may be some clients that will be ready to cede them or in a short period of time get up to speed to say, we liked you at your old firm, and now we know why you left, because you can't really do the smaller things you were doing, and you see a lot of attractive opportunities, but you grew to $6 billion, and you can't do that in the only thing you can do in a $6 billion fund that's concentrated is larger names. So we know why you left. We appreciate why you left, and you know what? We think that makes sense. So you may get a bit of a runway with some of these ex-clients, or that just want to have a complement to what the old firm was doing. There are situations where the manager comes from a long career and decides that they want to do something that's much more independent. Then there are situations where it's fresh, it's a super bright individual, it's someone you want to give money to, but it may be a tough sell for somebody that doesn't know that individual. So there are sort of different types of investors that want to launch their own strategy. We look at it as different steps. There are different steps that you can choose, and there are different types of third-party marketers that you can work with. Todd, who, as I said, spent his career doing manager due diligence, part of when he launched Lyndhurst Investment Consulting was to help coach new managers, boutique emerging managers, on the due diligence process. What they should anticipate in terms of questions, concerns, how to address those questions and concerns, what to put in your book, what to talk about in your book. It should be used as sort of a leave behind to be your voice when you're not there. How to think about your letters. Everything that a new manager should think about in terms of which target market they want to go after, what they should anticipate when they go after that specific target market. So Todd can do that in about 3 months. And there's a retainer fee, it's a consulting fee, it's not a full-blown relationship, but it kind of gets them ready for prime time, for lack of a better phrase. That's one way to do it. It's a better economic way to do it than maybe a full retainer. There are third-party marketers who structure their economics in more of a eat what you kill, meaning you will get paid, a third-party marketer will only get paid if they raise capital. So there's no retainer, it's a higher fee on those assets that come in as a direct result of the third-party marketer, but it's less of a risk, so to speak, for the manager, because the manager doesn't have to really outlay anything but time. So they'll be doing meetings, they may go to colloquiums where they'll present to a group of 12 CIOs, and there might be another manager there. And if the business comes in, it's going to be your work beyond that gets you the assets. The capital intro person is less of a third-party marketer, more of a introducer. This is a forum I've created. We have a great audience of investors. My network is terrific. You will come and spend 40 minutes presenting an idea. You'll hear from the CIO of University of X. They'll talk about what they're doing. And so there's these sort of forums in which it's more of an introduction, but that's it. The third-party marketer or the cap intro person is not going to, do the follow-up, go visit the university in Grinnell or wherever. So it's a very, in those cases, they're good if the person has a great network, but it's an intro and then you do the work. For us, we've gravitated towards a nominal retainer fee for the first few years. In addition, we could do that initial consulting just to get them ready and give them a sense of when the timing would be right, what they need to be thinking about. But if they want a full relationship with us, and we deem it to be a good fit for our philosophy, and we think that there's an audience amongst our network that would have an appetite for it, it's a retainer over a few years, and then we, in exchange for a reduction in the fee on assets that we raise. So there's an offset. There's things that could be toggled up or down. So the retainer can go down, but then the fee will go up, and we try to work our way into something that makes sense with our managers. I mean, the timing is, if you're going after consultants, you know they want 100 million in assets and 5-year performance, and even that may not be enough, and some of the larger institutions. Whereas family offices, independent thinkers, folks that don't have to go to a committee that says, you know, explain to me why we're doing this with this $75 million fund, they may be more open to these types of managers. So a lot of it depends on the audience, the target market that you need excuse me, to decide that that's who you want to partner with. There's a lot of variables in terms of evolution, but you know, we've seen managers, and I think I mentioned this to you, that have not been a portfolio manager. They've been an analyst at a very named firm, and day one have been able to raise $1 billion from 12 endowments. So there's no perfect formula. As I said, no one size fits all, but you'd have to look at different variables to decide when it's right to hire us, because you know, even if it's a $40,000, $60,000 a year retainer, so these smaller funds don't have a lot of extra disposable income to be spreading around. You want to do it when it's the right time. And we would never take on a manager that we don't think we would be able to get meetings for and get sort of involved in the process right away. My biggest fear would be to take a retainer and not provide any ability to get them in front of the right folks and hopefully get them on the pathway to raising capital. It's just not in my nature. We want to make sure that there's going to be a high probability of success before we take that step. But that's a conversation we're happy to have with your audience. If anybody wants to reach out to us, we're always interested in talking to interesting investors that are doing things the way we do them. And if you look at our website, we list those preconditions for investment success. So it's fairly simple for a manager that's emerging to say, yeah, I kind of fit these. Let me talk to these guys. So we're happy to do that.